Happy Monday, everybody. All right, I hope you all had a great Super Bowl weekend. And obviously, I'm filming this before the Super Bowl. So honestly, I'm just hoping there's a good game. But if you're a Chiefs fan, go Chiefs. If you're an Eagles fan, go Eagles. Or if you're a Taylor Swift fan, maybe Kelsey will propose to Taylor Swift. Um, anyway, I I want to talk about Greg and my strategy. You all know that we do our own research. We do our own investment decisions. We build the portfolios for our clients. We're not just pumping our clients into a program and then letting them buy a ratio of 60% stocks, 40% bonds. We're actually thinking about what's going on, and we look at global trends, we look at national politics, we look at global politics, we look at monetary policy, we look at inflation, we look at tariffs. Those are big on everybody's minds right now. We put we take all of these into account when we're talking about these. One of the things that I've talked about recently is the Cape-Shiller ratio, which is one of the ratios that we look at to determine um, the relative cost of the stock market in terms of what it's worth. And it's our opinion that it's just highly overvalued. There's the Cape-Shiller ratio. There's the Buffett indicator. We talked about this on the radio on our podcast, but we're constantly downloading information just so can rest assured we're constantly downloading information, reading from different news sources all over, including what Wall Street puts out. Now, Wall Street has a mission: sell the stock market. So I found it interesting recently. I was reading some analysts from Goldman Sachs and Morgan Stanley that are saying the same thing that we're saying. So uh, David Kostin, he's the chief investment officer for Goldman Sachs. At the end of this last year, he is predicting a 3% stock market return over the next 10 years through 2034. That's essentially flat. Um, and to average out 3%, that could be 10 years of 3% growth. Or it could be a doozy of a correction and then slowly going back up till you've got basically a 3% growth over those 10 years. So it doesn't say, he's not saying what he expects to happen. He's just kind of portraying a big expectation, macroeconomic level, saying that this next decade is not going to be the decade we've seen for the stock market for the last 10 years. And he is on the stock market. His job is to sell the stock market, and he is even saying this. Another one was Mike Wilson. He's the chief financial analyst at Morgan Stanley. He's basically saying the same thing. He didn't actually give a percent. He said the next 10 years are essentially going to be flat. And you can actually take a 3% return as being flat if inflation remains 3%, 2 to 3%. In real terms, if the stock market is going up 3%, but inflation's going up 3%, then you've essentially been flat. So he's basically saying the same thing. So, not to pat ourselves on the back, but it is interesting that it's not just Greg and I with independent thinking that's saying this, that now we're actually hearing this from top stock market analysts whose job is kind of different from Greg and mine. Our goal is to make you money in good times and in bad and to protect your wealth. Their job is to build up the stock market. And recently, what we've seen is a glimpse at how that could happen because when the stock market's going gangbusters, it's hard to imagine a turnaround. But when we saw the news that DeepSeek came out and essentially produced a valid competitor against ChatGPT, maybe not quite as good, but pretty darn close, and at a fraction of the cost, and from China, where we didn't think that they were that competitive with AI. We thought the United States was the biggest player. And all of a sudden, you've got this kind of Sputnik moment coming out of China saying, whoa, there's a competitor. Well, what did that do to the stock market? It pulled down the top 7 stocks because they're all they're all artificial intelligence stocks, primarily NVIDIA, who has been selling computer chips like crazy for AI. Well, the news coming out of China was that DeepSeek didn't need as many chips as everybody had previously thought. So it pulled down uh, NVIDIA's stock price quite a bit. And so for Greg and I, what we're seeing with the stock market is this concentration in these 7 stocks primarily has pulled up the entire stock market. Now, that concentration, we've only seen that twice before in the stock market, where the top 10% of stocks have all of the wealth concentrated at this level. The last time it was concentrated at this level was the dot-com bubble in the late 90s. And then we know what happened after that. It was a big correction, and it took about 10 years, or actually 14 years, for the stock market to get back to where it had been and then keep going. And then the time before that was 1929. Yeah, the great stock market crash. Those are the last 2 times where the stock market was this concentrated in this few of stocks. So it's not just Greg and I saying this. For those of you that might have wondered, hey, is this just Greg and Walt? Well, no, now actually Wallstreet is saying it. Some of you may have already read this, but if you haven't, I just wanted to get you up to speed, congratulate you because you're on the right track, and we're going to keep making decisions to protect your wealth and grow it in good times and in bad. And with that, you guys have a great rest of the week. Take care. Oh, and if you like this video, please, we appreciate a thumbs up and subscribe to this channel. All right, take care. Bye-bye.